Bonds, bonds, bonds. Fun time coming for the bond market. Rates are on the rise. This, of course, means that it's going to be a challenging couple of months, if not year or so, for the bond markets. But there's rosier roads ahead on the backside of this. So let's talk a little bit about the bond market, what rising interest rate means, and more importantly, how we look at it, and especially investing through these times. So first of all, what is a bond? We all know about the stock market. Stock market's this, you buy equity and ownership in companies, and it's much more volatile than bonds, generally speaking. Bonds are secured paper. Essentially, Amazon issues a stock, means you own parts of Amazon. They also issue a bond, which means that they are issuing debt. And when you buy a bond, you're buying debt. It's like owning the mortgage versus the house in a sort of a property analogy. And what happens is you buy a bond, let's say for $1,000 from Amazon, and they say we're gonna pay you 3% every year, and at the end of 10 years, we're gonna give you $1,000 back. Pretty nice of them. Big company, pretty secure. They're considered investment grade paper or bonds, and that's how they work. Now, what most people don't realize is the bond market is substantially bigger than the stock market, and I mean substantially bigger, as in trillions of dollars bigger. So, okay, let's talk about what rising interest rates mean to the bond market, and then we'll talk about how we have to invest through it. So rising interest rates are interesting because what happens is there's what's called a inverse relationship between interest rates and bond prices. What does that mean? So when interest rates go up, the value of your current bond goes down. So if you own a 3% bond, yes, if you held it to duration, the current market price may reflect lower than the $1,000 you paid, but at the end, you'll still get your $1,000 back. However, bonds are, as I stated, often traded in the open market. And what happens is, if you think about it intuitively, let's say Amazon issues a 3% bond, and they do it based on what the Fed interest rates are, because they know you can get risk-free paper, essentially treasuries and things like that from the government, and when you purchase them, they're paying, let's call it 2% now. So to entice me, the investor, to go take on risk and pay, and albeit relatively low risk, but for me to take on that risk and go acquire Amazon's bond, they better give me a better rate. So they'll pay 3%. Makes sense, right? So interest rates and the current price of bonds, or I should say new issued bonds, are, there's a spread. They're always trying to stay a couple steps ahead. So now here's what happens. Interest rates go up at the Fed. So let's say the Fed interest rates now are 4%. Well, that means if Amazon's issuing a new bond today, they're going to pay 5% on that bond. You hold it 10 years, you get your money back, and all along you get 5% dividends each year, or yield. What this means, though, and that's great for new bonds, but what happens to the guy who owns a Amazon bond at 3%? The value goes down, because why? What would entice me to buy Mr. 3% Amazon bond owner's bond when I can go to the market and buy 5%? Same risk, same company, same everything. Well, you wouldn't, unless I sold it to you at a discount. So why would I sell it to you at a discount? Because one, I want to get into different bonds. I need to sell for many reasons, and because it's the only way I can offload that bond. So instead of paying you $1,000 from your bond, maybe I'll pay you $900. I'll still take the 3% a year, pay you $900, knowing that at the end of the duration, I'll get my $1,000 back. So you get the $100 spread plus the 3% instead of a new issued bond at 5%, and just get your money back. So that's what happens to current bonds. So it becomes a challenging environment for the next year or two, whatever whatever it takes till we get to normalized interest rates at the Fed and things sort of flatline a little bit. And so what do? How do you invest in this environment to take advantage of what's going on? I'll start by saying, by no means should you abandon bonds. Basically, you got to grin it, you got to deal with the couple lumps along the way over the next year or two. And the beauty is, there really is a pot at the end of the rainbow, because at some point now the bonds are paying a much higher rate and you can own them for as long as you want. But you have to get through this time period, and you have to deal in the bond markets unless you're 100% in the stock markets, and most people we deal with or come across are not 100% in the stock market. So what are it's called 5 ways to get through this. 1, you diversify. There are many types of bonds: municipal bonds, corporate bonds, high yield bonds, emergent market, mortgage-backed securities. So if you spread out the risk a little, you're taking advantage of different parts of the market, and generally you can get through this choppiness a little better. So 1, diversify. 2, you shorten the duration. What that means is, instead of buying 10-year or 20 or 30-year bonds, you shorten bonds to 1, 3, 5-year bonds. What does that do? Well, they're less sensitive to an interest rate increase. And so you shorten some of your bonds, and then what happens is when you get on the back end of this, that's when you lengthen it. That's when you go, okay, now they're paying 5%. Now let's sell all my short-term bonds and buy 5%, 6% bonds, and own them from 10, 20, 30 years, locking in those interest rates. Next is you take a little more risk. You've heard of high yield or junk bonds or things of that nature. And what you do is you buy maybe not Amazon companies, because companies that have perceived not quite as strong financial health, well, the way they're going to compete with Amazon is they're going to pay, instead of 3% what a current Amazon bond has been paying, maybe they pay a 4 or 5% to entice you to take their bonds and purchase their bonds. So that's a decent way to get through it. Floating rate, so there's TIPS and there's bonds that are tied to inflation. Generally speaking, we'll see some inflation for some period. So that's a great way to combat this rising interest rate. And the final one that we look to is you can get what's called floating rate bonds, and they're a lot of times they're bank bonds and things of that nature. And these bonds will go up as you pay a little premium, but they go up as interest rates are increasing. So again, we don't think there's a one-size-fits-all, but there's a lot of good pieces here that can help you in the challenging bond market that's ahead. Hopefully, you got a couple tips, you learn a thing or two. It'll help you at your next cocktail party. As always, I'm Andrew Rosen. Stay wealthy, stay healthy, and stay happy. Bye.